Welcome! If you're around for daddy and feel behind on retirement, this video is for you. We'll show you how disciplined contributions, account consolidation, and smart use of limits can reset your trajectory. Let's begin by previewing what we'll cover and how to move from overwhelmed to organized. Here's our roadmap. First, we'll talk about why a disciplined mindset can change your retirement trajectory. Next, we'll tackle consolidating old accounts the right way. Then, we'll decode contribution limits across IRAs, 401 kiloseconds, 403 BS, and 457 BS. After that, we'll lay out aggressive catch-up tactics if you feel behind. We'll close with a quick Roth versus traditional comparison, an action checklist, and a couple of quizzes to lock in the learning. Before we dive in, a quick but crucial note. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique. Please consult a qualified professional, such as a financial planner or tax advisor, before making decisions. Transitioning into our first idea, here's the mindset reset. You are not behind. You are entering your acceleration phase. Retirement readiness is less about hitting a magic number at 40 and more about disciplined contributions and smart account management. Consistency, not perfection, is what compounds. Next, let's handle old retirement accounts. If you have a 401k or 403b from a previous employer, your choices are to leave it, cash it out, or roll it over. Leaving it can be acceptable if fees are low and investments are strong, but many people benefit from consolidation. Cashing out is heavily discouraged because of penalties and ordinary income taxes. The preferred route for most is a direct rollover. Move a pre-tax 401k or 403b into your current employer's traditional 401k or a traditional IRA to maintain tax deferral. Be very careful not to roll a pre-tax account directly into a Roth 401k or Roth IRA accidentally. Doing so triggers taxation on the entire rolled amount in that year, the so-called tax bomb. Roth to Roth rollovers, by contrast, usually do not create a tax bill. Also, use a trustee-to-trustee process to avoid withholding and 60-day redeposit rules. Consolidation gives you clearer allocation, better oversight, and simplified rebalancing. This flowchart visualizes your options. Starting from an old employer plan, you can leave it, cash out, or roll it over. Leaving it requires checking fees and investment options. Cashing out leads to penalties and taxes and is typically a bad choice. Rolling over splits into three cases. Pre-tax to traditional preserves tax deferral, pre-tax to Roth triggers a taxable event on the full amount, and Roth to Roth typically avoids immediate taxes. The recommended path for most people converges on consolidation to improve simplicity and control. Quiz time. The question is, what happens if you roll a pre-tax 403b directly into a Roth 401k? Option A, nothing changes. It stays tax deferred. Option B, it triggers taxation on the entire rolled amount for that year. Option C, only growth is taxed. Contributions are tax-free. Option D, it is penalized but not taxed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, it triggers taxation on the entire rolled amount for that year. This is the tax bomb. When you move pre-tax dollars into a Roth account, the entire amount is included in your taxable income for that year. If you ever choose to convert, plan it deliberately. Consider partial conversions and coordinate with a tax professional. Now let's decode limits. First, IRA limits are separate from employer plans. For 2025, the IRA limit is $7,000, and the 401k and 403b employee deferral limit is $23,500. Second, that $23,500 limit is shared across all your 401k, 403b, and similar employer plans within the same year. Third, most 457b plans have a separate limit, meaning you can contribute to both a 401k or 403b and a 457b in the same year, effectively increasing total savings capacity. Next, remember that Roth IRA contributions do not affect how much you can put in your Roth 401k. They are separate channels, subject to their own eligibility rules. Finally, once you turn 50, catch-up contributions increase your allowed amounts. For example, an additional $7,500 for employer plans and $1,000 for IRAs, noting that these figures can change with IRS updates. Here's a quick reference. Traditional or Roth IRA base limit is $7,000, with a $1,000 catch-up at 50+. Employer plans like 401k and 403b have a base limit of $23,500, with a $7,500 catch-up at 50+. For 457b plans, the base limit is typically $23,500, and they generally have separate limits and unique catch-up provisions. Check your plan details. Second quiz. Which statement is correct? Option A. Your Roth IRA contributions reduce how much you can put in your Roth 401k. Option B. The $23,500 limit is separate for each 401k you have in the same year. Option C. IRA limits are combined with employer plan limits. Option D. You can contribute to a 401k or 403b and a 457b in the same year, because the 457b usually has a separate limit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, you can contribute to a 401k or 403b and a 457b in the same year, because the 457b usually has a separate limit. This dual-track approach can accelerate savings for those with access to both plan types. Moving on to acceleration tactics. The main lever is your savings rate. If you feel behind, target a savings rate between 20 to 35% of gross income, using auto-escalation features to increase by 1 to 2% annually. Prioritize accounts by securing your employer match first, then maxing your employer plan, and then maxing your IRA. If eligible, use a health savings account because of its triple tax advantages. Once tax advantage space is full, deploy additional savings to a diversified taxable brokerage account for flexibility and long-term growth. Next, earmark a large share of raises and bonuses for retirement contributions for the next year or two to accelerate compounding. Maintain a diversified, risk-appropriate asset allocation and rebalance periodically. Keep 3 to 6 months of expenses as an emergency fund and aggressively eliminate high-interest debt. If your income blocks direct Roth IRA eligibility, consider a backdoor Roth strategy, being careful with the pro-rata rule. Finally, consider building side income and channeling most of the profit directly into investments. This timeline lays out a decade-long structure. In the first 90 days, consolidate old accounts and automate contributions. Year 1. Aim to max your employer plan and your IRA. Over years 2 and 3, refine your asset allocation and use an HSA if eligible. Between years 3 and 5, push your savings rate higher by capturing raises and bonuses. Through years 5 to 10, maintain the elevated savings rate and expand taxable brokerage investing. At age 50, activate catch-up contributions to accelerate further. Here's a quick comparison. Roth uses after-tax contributions and offers tax-free qualified withdrawals in retirement, which can be advantageous if you expect higher tax rates later or want tax diversification. Traditional uses pre-tax contributions, provides an immediate tax deduction, and results in taxable withdrawals in retirement, potentially better if you expect lower future tax rates. Many households blend both to diversify tax exposure across future scenarios. To make this actionable, follow a checklist. In weeks 1 and 2, list every old account, contact your current plan to start a direct rollover, and verify that pre-tax funds go to traditional accounts while Roth funds go to Roth accounts. In weeks 3 and 4, set contributions to capture your full employer match and enable auto-escalation by 1 to 2% per year. In months 2 and 3, raise contributions toward the maximum in your employer plan and concurrently open and fund an IRA. In quarters 2 through 4, add an HSA if eligible, rebalance your portfolio twice a year, and direct raises and bonuses to savings before lifestyle creep absorbs them. Let's cement the main ideas. Consolidate old plans and avoid creating an accidental taxable rollover. Maximize separate buckets, including both IRAs and employer plans. If you have a 457b, use it as an additional channel. Increase your savings rate with automation and escalation. Prepare to use catch-up contributions at age 50. Finally, stay diversified and rebalance to control risk. In summary, you are not behind. you are accelerating. Rollover accounts correctly, pre-tax to traditional, and Roth to Roth to avoid unnecessary taxes. Know your contribution limits. In 2025, $7,000 for IRAs and $23,500 for employer plans, with 457B plans typically having a separate limit. Push your savings rate, automate increases, and rebalance. At 50, use catch-up contributions to add further momentum. Before we go, if this video helped you reframe your retirement plan, please like the video, share it with a friend who's catching up, and subscribe for more practical money strategies. Tell us in the comments which step you'll tackle this week and what questions you want covered next.